now we are starting with a panel discussion number one, referring to the key concepts for the startups. And this panel is about to focus on what startups, how to increase the learning opportunities for startups and increase their understanding of what are the strategies of angel investors or angel investors groups and all related issues. I would like to invite Eythor Jonsson, the Managing Director of Center for Corporate Governance at the University of Iceland and WBAF High Commissioner for Iceland. Eythor, welcome. Now I would like to invite Charles Sidman, founding member of American Angel Capital Association and the board member of WBAF. I would also like to invite Marek Rusiecki, President of the Management Board of Xevin Investments Poland and WBAF Senator. And of course, I would like to invite Ramin Komilian, founder of Ivar Angels Investors Network from Iran and also WBAF High Commissioner.
So good morning, everyone. We're really excited to be here. And we're looking forward to an interesting discussion about this interface between startups and VCs and business angels. We have three rock stars here, really, from the VC industry. So, and actually, who have either running a VC fund or a business angel network themselves. So it's really exciting, and I'm just gonna ask them to give us a very short kind of introduction about their associations, and we just start with Charles Sidman. So the Angel Capital Association, why is that important organization?
Okay, well, thank you. It's a pleasure to be here. My affiliation listed on the program is a founding member of the Angel Capital Association of the United States. I am a practicing angel, have been for a long time. I was one of the first members of the Angel Capital Association. I am also a fund manager, and I'm a crowdfunding advocate and a public market participant as well. So I work in all of the financial tools to support and finance startups. The relevance of the Angel Capital Association to me is it's probably the deepest, largest pool of experience of doing early stage deals with startups. So the United States represents probably 50% of the startup activity on the planet today. VCs put into early companies about as much money as angels do, but angels put in money into 10 times as many deals. So if we just look at the number of deals that have been done by angels, it's huge, and the Angel Capital Association is probably the largest body of such experience. So whether you're a fund manager or a crowdfunder or working with early stage companies in any way, shape, or form, you can learn a great deal from the Angel Capital Association. And I'm not saying it's better than its peers of EBAN and all the other organizations, but it's the largest and greatest body of experience, I think.
Perfect, thanks. And we have Marek from Poland, who is as an entrepreneur himself and recently been running an investment company. He's also very known in Poland for being one of the meanest dragon in the country. So he's part of the Dragon TV show. So that makes him a real TV star and rock star. So tell us a little bit about the relevance of Xevin Investments and kind of how you see that as a valuable tool in Poland.
So I co-founded Xevin in 2008 in Poland, in Warsaw, and it was probably one of the, maybe not first, but probably second and third venture capital in Poland. So that gives you the view how the market looks like 10 years ago, 11. Since that, we've made something like 70 investments, mostly in Poland and European Union. Few in Israel. I think that Israel is the second hottest place after Silicon Valley in the world. and we've made something like 20 exits so far, mostly successful. We are not a public company, so we don't have any official reports. So I don't know what was the IRR even. Maybe this is strange, but we don't have any private LPs, so only the group of friends set up this company. So general managers are limited partners. This is the something which differentiates us from a regular VC. So we were most like angels fund, not regular VC. Now it's changing. Now Xevin has a group of funds with also the LPs, which are government funds of funds.
Thank you, very good. Ramin, you of course been running a company in Iran which is very, very successful. But recently you kind of created a business angel network. So why create a business angel network in Iran? What do you see the kind of potential and the value?
Good day, everyone. Well, what you have to understand is Iran has a very growing ecosystem. So we have a huge talent pool, and the traditional methods of investing, they've been stagnating for the past few years. So once one of the first few technology startups, they started getting traction, the whole notion of startups started picking up. I wanted to get involved, but you have to understand that you have to go through different phases. So the first thing that I thought was, Iran needs an angel network. So I started tapping into my network that, I think we should get together, we should start this network, we should start investing. And so we started one of the first, I would say the first angel network in Iran around 4 years ago. And I'm still involved in another angel network, and I'm also on the board of a crowdfunding platform called Pars Funding. Did I answer the question?
Very good, very good. So we were interested in this discussion and kind of how to get entrepreneurs to understand a little bit better this world of venture capital, and now we have business angels like informal venture capital and more formal like in VCs. So and if we start with you, Ramin, kind of what do entrepreneurs really need to know about business angels and like Business Angels Association? Why is it important, and how do they reach you, and what should they know about you guys?
Well, although we have a big country, it's a small community. So the events, when they go on, it's easy to reach angel investors. Each angel network, they have different events. They hold sessions. They have routine meetups, which entrepreneurs, they can interact with angel investors. The email is public, so they can always tap into our website. They can look it up. They can email us, and they can send their send their ideas, pitch decks, whatever information they have, to convince investors to meet with them. And you have to understand, we have quite a few VCs in Iran. One of the problems is probably a few of these VCs, they're backed by the government, which then the entrepreneurs themselves, they don't want to interact, because although they have a deep pocket, they also are very controlling and very demanding in terms of getting shares from these entrepreneurs.
So Charles, similar to it, maybe you have a huge experience, and of course coming from the States, you know this world of angels very well. Not that angels is a good word for it, but let's stick with that. So what do entrepreneurs need to know about business angels?
Well, one of the first things I'd like to suggest is that the real differences are not between these categories. An angel is not necessarily different from a VC, from a crowdfunding portal, necessarily, just by its term. What an entrepreneur needs to know is that there's a huge diversity. I will come back to trying to generalize a little bit, but what's most important is the diversity of entrepreneurs and the diversity of funders. And an entrepreneur needs to find a specific funder where there's a resonance and a compatibility. It might be that that compatibility is with a VC. It might be that the compatibility is with an angel or an angel group. So to me, that's most important. It's the relationship and the individual compatibility. Now, to generalize a little bit, I think it used to be that angels wrote smaller checks individually in smaller, earlier rounds for a company. That's still somewhat true, but there are all sorts of angels, and some can write checks to buy an entire company or even an entire country. So angels don't necessarily write small checks. What angels do, I think their really key point is that they're extremely diverse. They're the easiest of these groups to reach. As was just suggested, it's much easier to find some angels to begin your conversation. And angels are very diverse, so that some are exceedingly professional and hardcore and disciplined. Others are very generous. They'll work with you just for the joy and the pleasure of making a difference. So angels come in many shapes and sizes. VCs, their generalization is that they're all managing other people's money. Angels are writing checks with their own money. VCs are writing checks with other people's money. Therefore, they have some moral and legal responsibilities. It's called fiduciary duties. They must be more disciplined. They have to maintain a record showing that they took good care of other people's money. And then in some economies, it's very striking. I work around the world, and in some economies, companies are very used to going public very early. So I'm dealing with two companies now that are quite comparable. I'm a shareholder in both. They're both valued in the $10 million range. One is private, one is public. They just made different choices early on. So the real essence is when you're dealing with a young company, you want to provide financial backing, you want to provide and obtain financial backing, you want to provide and obtain support, experience. The specific form, financing mechanism, that's just a factoid. If you're public, you have to do things certain ways, and if you're private, you do things other ways. But of all of those, I think the most important is the compatibility between the entrepreneur and the funder.
Do you feel then there is a closer relationship between business angels and entrepreneurs than VCs and entrepreneurs, or is there any difference there?
That's often stated. I'm not sure I agree with that, because some angels want to write a check and don't want to have any interaction until the bigger check comes back. Other angels write a check and they want to join the team. And that's actually the best kind of angel, in my opinion, for an entrepreneur to seek, because that's what's termed smart money. It's money, but it's also wisdom and experience. A good VC is never going to just write a check and go away until the big one comes back. They're going to be on your team whether you like it or not. And some are gentler and some are less gentle, but they're going to be at your table.
Very good. Marek, you have a huge experience in financing companies and entrepreneurs. So what do you feel in terms of their strategy? What is a good strategy for an entrepreneur startup to raise funds from business angels and venture funds?
So, in my opinion, the right path should look like that. So there is an entrepreneur or startup, whatever, who has an idea and who would like to start a company. So first, mostly he should use private funds or private saving or family savings. So 3F, yes, fools, friends, and family. For example, in Europe, it should be something like in this case 50k euro, whatever. So the next step, and for this 50k, he should prove something. I don't know, build MVP, get first client, show something to investor. Because next step is, for example, business angel. And it's good to have something to prove that your idea can be a good company or be can be in the future a good company. So 3F, then business angels, and probably the third step is venture capital. Of course, this path was right in our countries a few years ago. Now everything is mixing. Sometimes startups are starting with crowdfunding platforms. For example, in our country, in Poland, they changed the law that you can fundraise with crowdfunding platform up to 1 million euro. So it's a, I can say, average check for VC in Europe. So the crowdfunding platforms are becoming our competitors. Of course, not every project can fundraise money with crowdfunding platform, but there is a possibility to get a lot of investors on the board. I can say those investors have no rights. It's individuals, it's even not angels. So yes, from my perspective, it looks something like that. So private money or private savings, then business angels, VC, private equity, IPO.
You want to add something?
Yeah. One thing that entrepreneurs should know, just elaborating on what Sidman, on what Charles and Marek said, is that fundraising is not a dot, it's a line. So if you want to find the right kind of angel that is fit for your company, you have to plan early on. So you have to have that vision and that milestone of where you want to go and when you need to raise funds. So when you reach that point, you already have had your meetings and know how much you want to raise. So at that point, you're not going to be reaching any critical stages in your company.
So you don't want them to come when there's crisis tomorrow.
Exactly.
No.
You want to think ahead.
You want to be early stage and kind of have at least a kind of couple of months where you're ready and still kind of enough money to run the company at least for half a year and a year. So talking on that, I mean, how do you feel the relationship is between? I mean, can you describe just a typical relationship between a business angel and an entrepreneur? I mean, how does that work? I mean, is it like a marriage? Is it like a friendship? Is it very formal?
Well, I'm sure Charles is much more qualified to answer this. He has much more experience. But in my opinion, the more formal the investment process becomes, the more formal the relationship. So when even in angel networks or angel syndicates, it's not as formal. You still are responsible for your own money. But once you are a fund manager, once you're managing a VC fund, you are investing on behalf of people. So there's going to be more regulations, there's going to be more lawyers, there's going to be more contracts. So the further in the stages of the investment you go, the more formal it becomes. Me, myself, I'm a very informal investor. So I'm always up for meetings. I always invite entrepreneurs to come to my office. I'm not so tough on where we should meet. So if it's difficult for them to come to my office, I will gladly go to theirs. But this is just a personal preference. I like it to be this way than to be much more formal. That no, the meeting has to always be at my office or in this framework.
So Charles, so you meet them always at Starbucks coffee, or you meet them at Starbucks coffee, or do you have other places where? How formal is the relationship in your mind?
Well, I'm just going to make a few observations that friendships versus marriages, some friendships you will die for your friend, and some marriages are quite loose. So there's a wide variety. I do prefer to go by my first name, Charlie. I'm not Dr. Sidman usually, or if I am, I'm usually in trouble. Yes, I do meet in Starbucks or in Dunkin' Donuts or whatever. I like to have them to my place. I like to go to their place. But I want to balance this because we've been talking about being friendly and low-key. There are expectations on both sides, or there should be, as to how you're going to behave. And those are often encapsulated in the laws and documents underlying a deal. Now, some people Some investors are willing to be very loose, very, oh, fine, I'll invest in whatever way you want, and suggest, and however it works out, it's kind of like the rolling of a roulette wheel, and if it works, it works. If it doesn't, it doesn't. Other people have a real expectation. If they go to the casino, they expect that there's only 4 kings and 4 queens in the deck. And when 5 or 6 show up, they're upset. So I'm one of the more disciplined, more formal. I do have expectations. The documents are very important to me. And in my mind, that understanding and discussing these issues and getting everybody on the same page saves a lot of grief and unhappiness later. If we can agree to disagree early on, we don't do the deal, but we can still be friends. If you begin a relationship and then it turns out you're coming from different places, that's painful for everybody. So I'd rather avoid that situation.
So do you formalize the expectations, or is it kind of just through the dialogue that I expect this of you, or is it like contractual?
Well, it's both.
Yeah.
It's certainly, in my experience, contractual, and if it can't be reduced to written descriptions, I won't do the deal. Other people have a different approach. But it's also a handshake, and that's one of the important things that, to me, it's the person-to-person interaction. I cannot conceive of writing a check to an enterprise or a person that I have not met, that I've just interacted with over a computer connection. And so the handshake and the feeling of confidence and reliability and trustworthiness is super important. And that's actually what we're often getting to when we have these initial conversations. We can talk about the business plan and the technical basis and the market for a project, but it's the give and take and how people respond to challenges and questions that we're really trying to assess the person, not the subject of conversation.
Yeah. So Marek, let's take it a little bit more heavy subject. Valuations of company, that's sometimes where the expectations are very different. I mean, entrepreneurs think their company is a billion-dollar company already, and an investor might be looking at the cash flow. So how would you make evaluations around companies?
Okay, and your startup, if you are asking, is making money or not? Pre-revenue or post-revenue?
So sorry, I did get the last one.
The valuation depends if the company is pre-revenue or post-revenue. So my question is, which thesis?
Which stage they are? Yeah, I mean, let's talk. I mean, we're talking business angels, so early growth startups. So they might have a proof of concept and start an early first selling. So they don't have a track record which you can kind of calculate in the cash flow. But the expectations are great. I mean, so what do you do? How do you calculate the future?
You know, this is the hardest way to evaluate the company with pre-revenue, because you have to probably evaluate the people, the founder or founders who are behind the project, their experience, their CVs, their track record. And of course, idea, total addressable market, all this stuff, but generally, idea is worth $1 with no execution. So, you know, there are some, of course, special agreements that you can make. For example, now your idea is valued at 10 million, but if the exit will be 100 million, I can give you a special bonus or something. So more or less you can sign something in contracts, in investment agreement, that can be safe for business angels or VC. So even if the valuation of or expectation of funders are very high, we can agree with that and try to write something in investment agreement that give us a special return on investment when the exit will come.
So you feel it's not such a hurdle in a way in this? I mean, you can find a solution that fits both expectations, really?
I think that, we have a lot of projects that came to us with only idea. We accepted their valuation, which was probably crazy at this time. But then, at the exit, we made some money. So this means that everything can be stated in investment agreement. And
So what would be your advice to a startup? Should they have a specific number in their head, or should they be very open to the suggestion of the investors? Or
of course, it's really helpful if they have something in their head. But generally, we try to evaluate these companies or this idea and propose something to them.
Okay, very good. Do you have any specific, I mean, when you are talking to your entrepreneurs about valuations, or?
So one of the first things you can do is to see what is the cost to duplicate. So if they come to you and say, we have this idea, you bring on a piece of paper, how much money is it going to cost me if I wanted to start the exact same idea. Now this is extremely basic, because you don't bring into the experience of the entrepreneurs, you don't bring into effect their brand value if they have a brand. So this is one way, but this will give you a very basic and low-level foundation of the valuation of their company. The DFC or multiples, it's very hard to do, because if they're not generating cash. Maybe multiple could be easier, because, for example, you see if the average software industry is 10x, you can say, you know what, I'm going to value this company 10x as well. But as Marek said, a lot of it is just gut work, especially in the early stages of the company. But then again, you don't want it to leave it to chance. This gut work has to come from experience. And but another thing that you can do is you can say a stage-based valuation system. So if they have just an idea, I'm just going to value them at this amount. If they have an idea and they've created a basic MVP, I'm going to value them at this amount. If they have a MVP with a customer base, then I'm going to value them at this amount. Now you can create a range of each stage, which will give you a low ball and high ball, or a high end, low end of what each stage is going to be valued at.
And is that something that the network publishes, and an entrepreneur can see that? They can kind of have a rubrics and fit themselves in, oh, we are at this stage, or we might be...
Well, this is not something that I'm going to show the entrepreneur, but this is something in the back of my head.
Yeah.
Now you can use a mix of these methods, and none of them is written in stone. You just want to be able to use, you just want to have a yardstick to see how I'm going to value companies.
Yes, Charles.
What has been hinted at but not stated explicitly, and I think is very important, is this is a market transaction. We all have choices, both on the financing side and the entrepreneurial side. So you're trying to reach, what is the right price for a cup of coffee or a meal? You can get meals of different qualities, cups of coffee of different qualities. And so if someone is coming to me, my offering, there will be cheaper or more generous offers than mine. An entrepreneur should accept mine if the money plus the experience plus the connections, the whole relationship, the whole package seems worthwhile. On the other hand, when I'm talking to an entrepreneur, I've probably got 10 or 20 companies that I'm evaluating at any moment. And if an entrepreneur just doesn't seem like a good buy, you know, it's 10 times the price of the average cup of coffee, I'll probably go down the street, or I'll do business with another entrepreneur. So we all have choices, and it's a market, it's a negotiation, there's no absolute value. We have some guidelines, and academics have created some principles, but it's still a market transaction. And if it ever comes down to just a commodity transaction, the cheapest money, and I've seen entrepreneurs take this point of view, they get the cheapest money, and it's the dumbest money, and it's not going to do them, in my opinion, the most good.
So do you kind of encourage them to shop around, talk to many business angels, or I mean, as kind of you running a network or part of that, do you kind of identify a couple and say, hey, maybe you should talk to these guys? And
I don't necessarily steer them, but I do think it's very important for them to get a sense and make their own opinion on the state of the market, what options they have. And sometimes I'll discuss with them, well, really an angel group is your best choice, or in your situation, perhaps a crowdfunding opportunity is best for you, or a private equity, or they always have choices. And if one of my principles is to avoid regrets. So yeah, I could probably pressure somebody into a transaction or seduce them into a transaction, but if they're going to have regrets later, it won't be a good result for any of us. So I'd much rather they really understand their choices accurately and completely up front, and then if we're meant to do business together, it's much higher probability of success for all of us.
So there's this word called a term sheet, and that is scary for many entrepreneurs and startups. So what is it, Charles? What is a term sheet, and what should we know about it?
Well, a term sheet is that first document that describes from both sides mutual expectations in this relationship. The valuation is one of the terms that's been discussed. The kind of interest or security, is it a loan, is it equity, is it common equity, is it preferred equity? There's a whole list of dozens of potential terms and conditions and attributes of the deal, the relationship. And the more you can put down on paper, usually that's an education process. Entrepreneurs usually have not done as many deals as experienced investors. And so that's part of one of the first elements of wisdom and experience that you're contributing, even before you might write a check. And it's this conversation that you get to know each other better and develop concordant expectations. A term sheet is always just a description of an anticipated relationship. It's not a binding document. The binding condition only happens later when you sign the formal legal documents which follow and when a check is transferred. A term sheet is your best description of the relationship.
So Marek, your term sheet, is it like 100 pages or is it?
Yes, maybe not 100, but at least 15. When we started, we tried to make term sheet very, very clear and very easily, and trying to make it on 2 pages. But with my experience, I think that it's better to make the term sheet 10, 15 pages, because it's much more easier than to turn it into an investment agreement. So if we will make a deal, let's negotiate term sheet, let's negotiate all the details on the term sheet, then it would be easier. If the deal will be broken, let's make it when the term sheet is negotiation. So from my opinion, it's better to have a very detailed term sheet. And when we are talking about the points in this term sheet, of course, valuation, of course, the equity loan, what is the ticket, what is the check. But since few years, what I've seen, very important statement is about liquidation preferences. Yeah. So it changes everything. I mean, the valuation is not so hard to negotiate as this liquidation preference, because it can give the investor the guarantee of return of investment. Of course, there is no 100% guarantee. If company will go bankrupt, you will see nothing. But generally, liquidation preferences are very important this time. And almost every term sheet that I see these times has this liquidation preferences statement.
Okay.
I mean, I have to agree. One of the first deals that I made, we didn't take enough time to write a proper term sheet and investor agreement, and honestly, we had to just let the company go. There's nothing that we can do. If we want to get into a legal battle, we will lose. If we want to drag on, it's just a pain for ourselves. So you know what? We just have to leave it as it is. So, in my opinion, I agree with Marek that You don't want to make it a very lengthy document, but you want it to be thorough. You want it to think of all the aspects of what could go wrong, and there are not that many. So this is not something that is going to be different from company to company. The problems that could arise from a poor agreement is not very unknown. So you can think of it ahead and write a thorough agreement.
Yes, Charles.
My preference is for a shorter term sheet, a couple of pages, and my preference is for participating preferred equity. But I have had examples where a deal, an opportunity was so attractive to me that I have swallowed hard, and I've invested in common stock. I've invested once in a safe. I've done an occasional convertible debt. Sometimes it's always a balance. What I also want to add here is that the preference, it sounds like a good idea, and it's my choice to have a liquidation preference. It can turn around to bite you in the rear end also, because I can cite an experience where a company that I was an investor in the A round, and then in the B round, and the C, and the D, and the E. Well, the company had an exit. I made some money. All the money went to my Series D and my Series E investment with their liquidation preferences. My A, B, and C investments got nothing back. And so one of the rules is, once you write in a liquidation preference, you've opened Pandora's box. Every succeeding round is going to do that or even more beneficial to themselves. And once you open that box, you may regret it.
Very good, very good. I'm going to open the kind of floor. If there's any questions from the audience, raise your hand and you will get a mic. Don't be shy. Everyone is shy, yes. Okay. Okay, so I think one of the things that investors tend to do to kind of control their investments is to sit on boards. Can you tell us a little bit about your role working with the organization, and if it's through a board, and how does that actually work working through a board? Ramin, maybe you want to start.
I quite didn't get the question.
So when you kind of already made the investment, so you're working with the company, many of them take a seat as a board of directors, or they do it in a different way. So what's your preferences, and if it's on a board of directors, how do you actually approach that?
Well, you know, if you're on the board of directors and you got other investors involved, you're legally responsible. So, and I'm talking about an official board of directors role when the company is formalized. And so the only time that I can accept the role of being a board member is when I know that I can contribute. Okay. So I don't think there is any glory of saying I'm a member of board of 5 companies or 6 companies. There's no glory in that. If you're useful, you should be part of the members. If not, you should say, you know what, I want to have a hands-off approach. There are teams which are like the founders so much that I want to be more involved in their company. And there are times that, you know what, the relationship with the founders comes to a point which I try to avoid a more calm, a more direct relationship with them. So I leave it to other investors to take that role.
Okay, so but that means that you kind of working on the ground with some of them.
Exactly.
And you might have people which you know who sit on your behalf of boards and so on. So Marek, so how do you approach it?
So I'm trying to never be in the board of directors, of course. Responsibility. But we are creating something which is called supervisory board. I don't know if this is in law in the United States, something like that. Supervisory board which controls the board of directors. So there is a special body in our law that...
So you create an advisory board to every investment, or...?
Supervisory board is the 2 or 3 persons who are...
Oh, you're talking supervisory board, like,
yes,
right,
yes,
which is regulated, not advice. Okay, so yeah, so you have a 2-tier system.
One level
yeah,
above.
2-tier system, yeah.
And this is the common situation that funders are controlling board of directors, and we as a VC controlling the supervisory board. So they can make some decisions on their own, but some decisions they should ask a supervisory board. And in my experience, in our law, this is the best solution for us.
But I mean, sitting on a supervisory board limits your kind of access to strategy discussions and so forth. So don't you feel as an investor that you want to be involved in the organization somehow?
You know, I can always have a call, a Skype chat with the funders. It's,
okay, so
it's informal.
Yeah.
Informal way, supervisory board.
Yeah.
Informal way,
just
talking to them every day or every week.
Okay, perfect. Charles, you any a different approach to this? Or?
Yes, this is one of the areas where I'm quite passionate. I view a board as part of the team, just like you need your technology, you need your marketing, you need your CEO function, you need the experience of governance. It's part of the team, the diverse, complete team. It's part of a check and balance, just like most free countries have different chambers of legislature, and they have an executive, and they have a judiciary, and everybody keeps everybody in check and provides different expertise. I think the board does that in any company. I've been doing this for quite a while. I've had some successes, I've had some failures. One of the surprising generalizations to me was that every complete washout I've had, I ascribe not to a misjudgment of the market. I ascribe to less than proper behavior of the executives or entrepreneurs of the company, but in every case, that misbehavior or non-performance was not addressed by the board. So I've come to believe that every one of my investment failures has been a board failure ultimately. I think a good idea, a good company concept is rare, a good entrepreneur is rarer still, and a good board is the rarest of all. And so I think it's very important. I don't have to be on every board of every company that I'm involved with, but I want somebody with my experience and my perspective to be at that table. Because a founder or entrepreneur controlling the board is a recipe for disaster, in my opinion.
When Marek was talking, I thought he was talking about advisory board, which is something that we know from the US, Silicon Valley. So is an advisory board has no formal role, but usually kind of linked to the CEO. Charles, is that something that you use there, or are you familiar with that?
Well, what's common in our experience is two kinds of boards. There's a board of directors, which has the legal responsibility, and ultimately they can't strip an entrepreneur of his or her ownership, but they can fire him or her as the CEO of the company. They have the ultimate responsibility, and if things go awry or illegal things are being done, which, by the way, I could give a whole talk on that, it happens more than we would like to believe, the directors have the ultimate responsibility and liability for that. So they have to make sure things are done properly. A second kind of board, which is very common for us, is an advisory board, which is sort of technical experience and advice. They have no legal responsibility, so that's a much safer position to take. Both advisory board and board of directors should get compensated for their service, in my opinion, because it's not insignificant. They're doing real work which benefits everybody. So the supervisory board, the closest I can come is that our boards of directors, sometimes they have committees. This committee is responsible for renewing the board. This committee is responsible for setting pay levels. This committee is responsible for financial reporting. So that's subspecialties, but it's the board of directors as a whole, which is not responsible to the CEO, to the founder, to the entrepreneur. The board is responsible to the company And in my mind, that means all the shareholders.
I think it's important to know that there are different corporate governance systems in the world. So it's important to see that some places we have one tier, and other places two tier, and sometimes we have informal boards and so forth. So even when we were looking at the Nordic countries, it's a specific system in the Nordic countries which is different from the main Europe and the American system. So it's something for entrepreneurs to think about. We're reaching the end of this session, but I want to run the last question. I want to do kind of do's and don'ts of entrepreneurs when they're looking for funding. And Ramin, maybe if you start. So what's your advice to entrepreneurs? If they are going to try to raise fund for the company, what are the do's and don'ts that you think about?
Do think in advance, as I said in the beginning. One of the first things that an entrepreneur should do is thinking ahead when they're going to need money, because once you reach that critical point, and if you haven't thought about who to meet, it might be too late. You might be engaging with an investor which is not your top choice, is not your preference, but you need to do it because otherwise your company might not survive. Another thing is, take all the documents you sign seriously. Do think ahead about options. Do think about liquidation and preferences. These are all issues that an entrepreneur should think about when raising funds. They should know which investors are a better fit for their company. Also, they should know that time is of an essence. You don't want to waste too much time for raising funds, because again, you might face problems later on. These are the few issues which come to my mind.
Perfect. Marek, do's and don'ts.
Maybe only one advice that for entrepreneurs or startups who are looking for investor, particularly our fund, make a research. I mean that try to find information about our fund and think if we are fitting to the startup. I mean, there are a lot of VCs, there are a lot of business angels, and you have to make a research what are you looking for. If you are, for example, I don't know, biotechnology startup, you can visit my website of my fund and check that I've never made any investment in biotechnology. So probably I'm not the right fund for them. So it's very easy because there is everything, internet, LinkedIn, Facebook, whatever. You can check it, you can make a research, and be prepared before you send your pitch deck, for example.
Perfect. Charles, do's and don'ts.
Well, I agree with everything that my colleagues have suggested. When an entrepreneur comes to me,
Charles, when it's like that on the board, we have too many on the panel. If everyone is agreeing,
Well, so for my case, I tell people that it's going to take 6 months on the average. If you've done all your homework and all your investigation beforehand, maybe you can reduce that to 3 months. If you haven't, that 6 months is going to turn into 12. So don't come when you need to make payroll next week. Do your research ahead of time. Yes. And remember that there's a diversity of choices for you. So angels come in all shapes and sizes. Some are oriented more to their personal participation and the joy of that. Some are, particularly funds, are very financially oriented and disciplined. But what happens when you get into the whole impact world? Then you have multiple bottom lines. So you have to do your homework and decide, explore what's best for you.
Perfect. This has been a really interesting discussion. I think a very important discussion, because there is very often a gap between investors and entrepreneurs, and we need to have a dialogue about this gap so both sides can learn, because it's a learning process both on the side of entrepreneurs but also on the side of investors to understand each other's mindset, and then it's more likely to be a fruitful relationship. Please, ladies and gentlemen, thank the three rock stars here. Give them a hand.